Check.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning, welcome to the show. Of course, it's Tuesday as we get ready to kind of wrap up this holiday week. And again, as we get ready to move into Friday, of course, that's the 22nd. Next week, Monday, markets close. It's going to be a light trading week. By the time we get to that week, you wind up with New Year's. So over the next really few days, we're about to have some very, very light trading volumes we've talked about before. But these holiday breaks are also going to break up some of the market action as well. But again, right now, as we've talked about over the last couple of days, everything's fine. There's not really much to be concerned about. It's very interesting. We're starting to see a lot of exuberance coming back into the markets, both on a sentiment basis as well as just an investor basis, as well as the fact last Friday, despite the fact the market's been rallying since the beginning of November, last Friday, just a couple of days ago, record inflows into the S&P 500 ETF, right? So better late than never, I guess, to get in as markets are approaching all-time highs. I think now's a good time to get back into stocks. So, that's just kind of, how market sentiment works. Of course, over time, investors always tend to buy high, they sell low. And when things start going up, you start seeing headlines why, well, this time's different. And next year it's going to be, kind of up from here, and nothing's going to stop this market now, as this time's different for one reason or the other. And it's always great excuses, but markets just don't operate that way. And you should know that by now. When things get a little bit over exuberant, you're going to have some type of correction, and then people are going to get very despondent, and then you're going to have the market rally, and it's going to completely get you off sides. And that's the big trick with this market over time, is just understanding that markets don't go straight up, they don't go straight down, they do ebb and flows. And what goes up does come down, and vice versa. And that doesn't mean that every time markets are coming down, there's going to be a crash. It just means that you've got to work off some of that excess. And so anyway, this is just the function of learning how to work with your portfolio and just understanding risk and those type of things. And the basic tenet of investing, right, is to try to buy something that is cheaper than it's undervalued, right? I want to buy something undervalued, and I want to sell it when it gets overvalued. And that seems to be a very basic tenet that most investors forget. They feel like, and of course they're told by financial professionals and Wall Street and the media is like, oh, you've got to be invested all the time. You've got to always have your money in the markets. There's really no rule about that, right? If our goal is to buy stuff when it's undervalued, right, we should want to be buying things when things have been sold off a lot. When things get overvalued, we should want to sell them and take our profits and put that cash away and wait for the next opportunity. But see, we can't do that because we're always worried about missing out. We're always worried about that, what if, right? What if the markets just keep going up and I get left behind? Doesn't matter, right? We're so tied up into this game of chasing markets that we forget about the whole basic tenets of investing. I was having this conversation with a good friend of mine yesterday who does real estate investing. And, we were having lunch and talking about the real estate market and commercial real estate and multifamilies and all these things that are going on. And it's very interesting that, we were talking about real estate funds and talking about, these, kind of real estate investing groups, et cetera. And it's always very interesting that, a lot of these funds have gates on them, right? So that, if there's a downturn in the economy, what's the first thing that investors want to do, right? They want to get their money out of real estate funds, right? It's like, I got to get out. But that's the time you want to be buying real estate. You want to be buying real estate when it's cheap, right? But investors do just the opposite of what they should do. When real estate's booming and you have, prices at all-time highs, that's when everybody wants to get into real estate, right? We saw this with the real estate crash in 2008. Everybody was just piling in, and then it all blew up. So this is the important thing to think about when you're managing your own money, is what are you chasing? What's the real goal of investing? And there's nothing wrong with having a pile of cash sitting around waiting for a good opportunity. Nothing wrong with that. But see, we're so trained by the media that we always have to be invested. We've always got to be chasing something. We've always got to have our money doing something. And that's not really the way it is. I mean, people that are really, really good at investing, they have no problem sitting on cash and waiting for an opportunity. They don't have a problem missing out on a little bit of the market. But over time, they're very successful because they put that capital to work when there's a reasonable risk reward for putting that capital to work in the markets. And that's ultimately all it comes down to. Okay, my little diatribe this morning, sorry. This is what you need to know before the bell this morning. So one of the things that has been interesting about this market advance over the course of the last couple of weeks, actually last month or so, since the beginning of November, is the other asset classes that are helping drive that market. And one of those is the dollar. So, if you remember back in July, August, September, October, markets peaked back in July. We sold off in August, September, and October. And that sell-off in the market, here's the bottom in the dollar back in July, and that was the peak of the stock market back in July. And then as the dollar strengthened, right, the market sold off. So we're having this very strong rally in the dollar, and that led to that strong sell-off in equities through the very end of October. Then at the end of October, the dollar peaked in that rally, has been selling off here over the last couple of months, and we've retraced a lot of that advance that we saw in the dollar over the summer. So the dollar's weakened here markedly, very oversold here. And this is kind of a key point. So if the dollar starts to rally as we go into next year, so here's the thing about the dollar. So the dollar is a reflection of economic strength or weakness. So if everybody believes that the economy is about to turn the corner, and we've had weaker economic growth this quarter, so in third quarter, August, September, October, we had that really strong spat of economic growth, which not surprisingly led to a stronger dollar. Now we've had weaker rates of economic growth here over the last couple of months. Looking at a slower rate of GDP growth in the fourth quarter than we saw in the third quarter. So that kind of aligns with this sell-off in the dollar. So if we're expecting stronger rates of growth going into 2024, right, that should augur for a bit of a rally in the dollar, especially from these more oversold levels. So if the dollar begins to rally, that could be one of the catalysts that helps yank some of that money out of the markets here. Some of this recent advance that we've had gets pulled back here a bit. So again, one thing that we're just trying to look at is looking at, yes, you take a look at the market itself, as we talked about here over the last couple of days, extremely stretched, overbought on multiple levels, and very deviated from longer term moving averages. So it just, as we talked about before, these deviations, when prices get too far stretched above moving averages, those moving averages kind of act like gravity and pull prices back, but you need a catalyst to make that happen. Right now you have a lot of exuberance. Nobody wants to get left out of the markets, right? So we're all piling in here at the top of the market. which is normally the case. But looking at some of these other asset classes, bond yields, which are extremely overbought now, those need to have a bit of a pullback here. We need to see yields probably rise up to above 4% again. The dollar strengthens here on a rally. Expectations, maybe get a little bit disappointed on some of the economic data. Whatever we see, some of the data comes a little bit stronger than expected, so we see some inflationary pressures, which bring up yields. We see a little bit stronger economic growth data in the first quarter, maybe stronger retail sales over the holidays. That brings the dollar up on some renewed hopes for economic strength, right? And that's going to pull some of that tailwind out of stock. So again, there's a lot of reasons why this market can have a bit of a correction, but again, things can stay overbought longer than they seem. But again, the risk here is that markets are going to pull back probably sometime within the first couple of months of next year. So just again, as we were saying earlier, think about risk reward and how you're managing your portfolio right now. That's what you need to know before the bell this morning. When we come back, we'll get into today's blog post that is up on the website now. So we'll get to that right after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Coming up January the 27th, we're having a special event. It's called Navigating the Markets in a Presidential Cycle. Greg Valliere is coming to be the keynote presentation. Adam Taggart will be there. Michael Leibowitz, myself, will be spending the morning talking about the economy, the markets, presidential election cycles, what to expect. Tickets are on sale right now. Early bird registration on the website. If you go to realinvestmentadvice.com, click on the banner at the top. Tickets are $99. We've got very limited seating at Hotel Sonesta here in Houston. You get your early bird special now. Ticket prices will go up as we get into early January. Get your tickets now on the website, realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
Have the market's gyrations made you nervous? If so, it's because you have more risk in your portfolio than you realize. It's time to reevaluate your long-term investing strategy with RIA Advisors. Our disciplined approach can help eliminate unnecessary risk. We do that by having both a buy and sell discipline. Does your advisor do that? If you think it's time to work with an advisor who puts your interests first, it's time for real investment advice. RIA Advisors, 855-RIA-PLAN, RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
I've told you before that Brent always puts little notes on my note page in the mornings, and I never really thought about this, the 12 days of Christmas. It's weird when you realize how many gifts in 12 days of Christmas are birds. 6 of the first 7 days, your true love just gives you birds, right? 23 in total. I never really thought about that. Partridge in a pear tree, geese, ducks, it's like, what's up with all the damn birds? Like day 5, you get 5 golden rings, then bam, 6 geese. I mean, just right there. It's like, quick, give me birds. Give me some. Then people show up and they're like dancing around, they're milking stuff. I've actually, the more I think about it, I was like, what's the whole point of the 12 days of Christmas? Because these gifts aren't that great. Do I really want Pied Pipers piping?
It looks like a video from the White House.
I know, right? It's just like, hey, let's go to the Roberts house. It's crazy land over there. They got birds everywhere, dudes jumping around, piping, some chick in the backyard milking a cow for some unknown reason.
Whoever wrote
Now-
that was
now I'm totally-
really on something. I
Yeah,
don't know.
I'm really disillusioned now about the whole song. You made me actually think about it, right? All this time, I've never really thought about the 12 days of Christmas. Only thing good you get out of it's day 5. You have 5 golden rings. You can cash those in for something, especially with the price of gold these days. Anyway, sell cash, buy stocks. That is the latest recommendation coming from Yahoo Finance, and I wrote an article on this morning, and it's on our website now. So all the attendant charts and graphs that we'll go through this morning, if you want to go look at them and kind of analyze them yourself, it's on the website under the Insights tab. Go to the blog section and get our latest blog posts. But it's interesting because this was kind of a point made by the head of investment strategy at BlackRock America. Said, get out of cash now. Take advantage of some of these incredible things in the fixed income markets, especially in the belly of the curve. Take advantage of the companies that are still available to you at reasonable prices. So in other words, and this is something we did actually talk about last year, which was that individuals were going to make a mistake by piling, great 5% money markets. It's awesome. So you go and you throw all your money into 5% money market. You're like, woohoo, I'm protected. The market's going to crash. The world's going to end. And all of a sudden the market takes off, screams up to new highs. And all of a sudden you're kind of left there, with your hands empty, trying to figure out what to do. It's like, well, I've got all this money sitting in cash, but I'm missing out on the market, right? Yeah, you're going to make 5% a year in cash. That's fine for now. That rate's going to come down pretty quickly as yields come down, then the Fed starts cutting rates. That yield will go away. But in the meantime, you've already missed almost 12% return in the market just since October, right? So where were you better off? And this is always kind of the issue. But, the advice, sell cash, buy stock, certainly goes against the historical evidence. When you take a look at yield curves, as an example, that's actually good advice. And so if we go back and we look at yield curves throughout history, and as we talked about before here on the show, we track a composite index that we created of 10 different yield spreads. These are just kind of all economically sensitive and kind of entail different areas of the curve, right, where different activities occur. So for the short end, you're looking at the 1 year versus the 3-month T-bill, which has a lot of effect relative to what's happening with the Fed or what's happening with credit card rates, those type of things. And then the 10-year, 2-year, kind of longer end with your financing activities. So these 10 different yield curves kind of represent the economic cycle, right? Different aspects. And so if we go back and look in the, 1998, 1999, 2000, through 2003, we inverted the yield curve, and that was in 1998. And I know we talk a lot about 1995, but 1995, the yield curve never inverted, so it really wasn't a soft landing. But in 1998, we inverted the yield curve, market corrected a little bit. We had long-term capital management, but we never got above 50% of that yield curve inversion, so it didn't really count in terms of where we start looking for recession. When you get more than 50% of those yield curves inverted, that's your recessionary indicator. So just looking at one yield curve really doesn't give you a good indication of what's happening in the overall economy. But when you look at 10 of them and you say, okay, when I have a 50% break of that, that's when I'm going to see that inversion. So in 1998, yes, we had a yield curve inversion, but we didn't have the recession until 50% of those inverted in 2000. Then you had the recession, the dot-com crash, et cetera. So, yes, if you had gone to cash when you got 50% of those yield curves inverted, then you would have avoided the crash, right? So, if we take a look at 1989 through 1990, in 1989, you inverted 50% of the yield curves. And, over the next couple of years through 91, when you had the recession, you didn't really gain or lose. The markets were kind of flat during that period. They kind of moved all over the place. But between that period of time you didn't really win or lose. I mean, money market yields were higher then, so you were kind of okay being in cash. But if we take a look at 1977 as a good example, through 1983, we start looking at a period where we had more than 50% of the yield curves inverted twice. And in 2 periods, you were better off going to cash once you got there, right? And so that's just happened. So the point is, and we take a look at the same thing in 2006-07 as we inverted yield curves going into the financial crisis, much better off being in cash. Well, here we are today. And so let's take a look at where we are, as a fact of the moment right now. We had 50% of the yield curves inverted in 2019, right? And everybody was saying like, well, there's no sign of recession. And then, of course, in 2020, you had the recession. And here we are again, just a short period later. We have roughly 90% of all the yield curves inverted at the moment. But yet the market's about to ring up to all-time highs. So, is this time different, right? And the answer is no, it's not different. The question is timing. The yield curves are telling you that there's risk of a recession at some point, but just because it doesn't happen today doesn't mean it won't. Now, there's certainly an argument to be made that we could certainly have a soft landing. We've talked about it here before. We have lots of liquidity within the overall system. There's a lot of other indicators that are going on that maybe this time could be different. Sure. But historically, it hasn't. In fact, if we go back through history, whenever the yield curve has been inverted and the Fed starts cutting rates, the drawdown for stocks has been around 20%-ish. So we can look back and we can say, okay, well, 2022, we did have a drawdown of almost 20% in the market. So maybe we just kind of front-loaded the bear market of the Fed rate cuts. Maybe just the market front ran that. But that's not usually the case. And so as we start looking, throughout this cycle and start looking at this, this idea of selling cash now and buying equities at, today, there's certainly a lot of things that are impeding that. First of all, as we talked about, exuberance is back up to very high levels. So if you take a look at our net bullish ratio, this is the bull-bear ratio between retail and professional investors, and that's back up to levels that have normally coincided with at least near-term market tops, if not bigger corrections. Then, again, there's certainly things that are going on, but I think one of the biggest issues going forward, and this is something we talked about last Friday with talking about psychology, right? So last Friday we wrote about, and that article's on the website as well. So, go back to look at last Friday's blog. But last Friday we talked about the Pavlovian experiment that the Fed has done on investors over the last 13 years, which is that every time there's a crisis of any sort, the Fed's going to bail everything out. And we certainly saw that since 2009. That's been very much a case. We've had over 43 trillion. We've had roughly 43 trillion, and that's including the recent round of QT, of monetary infusions, both fiscal and monetary infusions into the markets, whether it's QE or checks to households, et cetera. We've had this massive surge of monetary push into the economy, the financial markets, everything else. And it's been a very poor trade-off, for $43 trillion of capital invested, surging deficits, surging debt ratios with the government. We've only had about $5.7 trillion worth of GDP increase. So there's not been a massive translation of all this liquidity into the economy. The economy's kind of limped along. So the question is where did all that money go? Right? We'll talk about that after the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Coming up January the 27th, we're having a special event. It's called Navigating the Markets in a Presidential Cycle. Greg Valliere is coming to be the keynote presentation. Adam Taggart will be there. Michael Leibowitz, myself, will be spending the morning talking about the economy, the markets, presidential election cycles, what to expect. Tickets are on sale right now. Early bird registration on the website. If you go to realinvestmentadvice.com, click on the banner at the top. Tickets are $99. We've got very limited seating at Hotel Sonesta here in Houston. You get your early bird special now. Ticket prices will go up as we get into early January. Get your tickets now on the website, realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
The tipping thing is getting out of control. They are tip shaming you at checkout. To walk up the counter, you got to order your food, you got to pick up your food, you got to bus it to your table, clean your table, put everything away. And so, when you go to check out, now it says 10% tip, good, 15% better, 20% awesome.
The Real Investment Show podcast.
And I'm doing all the damn work. This is like self-checkout at the grocery store. It's like, I want some cheerleader to come out and go, woo, you did a good job.
At realinvestmentadvice.com.
I should be tipped.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791, or online at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now, with the new and improved Before the Bell report. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So the question is sell cash, buy equities, and disregard the warning of the yield curve inversions. And, it's interesting. So we left off talking about the $43 trillion of monetary liquidity infused into the financial markets infused into the economy since 2008. That got us a grand total of about $5.7 trillion worth of economic growth. So, the investment didn't yield a great return on that investment, right? So where did all that money go to? Well, clearly it went to the financial markets. And if we take a look at the financial markets versus this liquidity push, we can see exactly where it all went and how it found its way through a variety of forms into financial assets, not just the Fed's balance sheet and QE, but everything else. Checks to households. People ran out, started, running up, accounts on Robinhood and trading meme stocks, et cetera. So, all the money found its way ultimately, or a lot of it, found its way into the financial markets. And the way that we know that is we can run a correlation between the cumulative change in government interventions and the stock market. And there's roughly about a 75% correlation in those. The only outlier of that was the financial crisis, where the markets crashed and we hadn't yet started those financial interventions. So those financial interventions started immediately after that crash. So you take that one little isolation off the correlation line, then right after that, ever since we started all these interventions, it's been a pretty high correlation to that. So we know that's where all the money went, and we know further that is the case because we can take a look at the net change of all these interventions between the stock market, the growth of GDP, and sales growth for companies, right? So we had so since 2009 to date, and this was as of last Friday, we've had a 230% increase in the value of the S&P 500. So that's from 2007. So 2007 crashed 50% in 2008, and since 2007 we're up 232%. During that same period, since 2007, cumulative sales growth. So this is the revenue that companies receive at the top line. Now we can do a bunch of jiggering around with the bottom line through accounting gimmicks, etc., stock buybacks, all that to boost EPS. But if you really want to know the health of what's going on within the economy, take a look at sales. Top line. Can't really fudge that very much. Well, that's only increased 90% since 2007. So you've got the market up 232%, sales are up 90%, and the economy has only expanded by 36% since 2007. $43 trillion worth of monetary interventions. Bailouts, maiden lane, bailing out banks, QE, checks to households, all of it, right? Cash for clunkers, cash for utilities, washers and dryers, all that stuff. Everything we did. TAMP, HARP, HAMP. Just massive infusions that did little to actually boost the economic quality of life, right? This is why we have these conversations about wage, disparities of everything else. But again, you can understand that after 13 years of this, right, that it's just the belief now that stocks only go higher, and that at every turn, the market is just going to get bailed out by the Federal Reserve. In fact, in October 31st, the market's sitting at its lows for the year. Powell says that higher yields and lower asset prices are doing the work for the Fed, and so AKA that meant no more rate hikes. And since then, the market has just had a rocket ship ride, that on the expectation that, the Fed's about to start doing QE and cutting rates. In fact, there's already estimates that by third quarter of next year, QT will be over. Fed's going to cut rates. So what does that mean? Well, if the Fed's going to cut rates and do QE, what am I supposed to do? Sell cash, buy stocks, right? That's what we've been trained to do for 13 years. And it's interesting because when we talk about all of this has all been driven by debt, right? We've got a $33 trillion debt bubble, in the government, household debt, consumer debt, just everywhere it's all debt. In fact, if we take a look at just the year-over-year net change in federal debt versus valuations, valuations traded between about 10 times earnings and about 23 times earnings on the high side, going all the way back to 1900 through about 1990. And during that period, we did not really run a deficit of any consequence. Very, very minute deficit. Debt to households was low. Debt to the government was reasonable. And we had no real deficit. And over that time, as you would expect, stocks traded within a range of valuations. If stocks got too overvalued, around 22, 23 times earnings, those corrected in valuations. And then they recovered again. And we just traded. And if you just look at valuations, they just were sideways from 1900 through about 1990. Then we decided that a little bit of debt's a good thing. Well, if a little bit of debt's a good thing, that means a lot more debt's even a better thing, right? And so since then, we've been just ratcheting up the amount of debt that we hold as a government. And during that course of time, valuations keep rising. We keep overpaying for more and more earnings and more revenue for companies, because as more and more debt is funneled into the financial system, it's got to go somewhere, right? So we keep justifying why we have to keep overpaying for assets as more and more of this debt has to be ultimately absorbed. So, the problem, of course, becomes when a recession occurs. And a recession will occur at some point, right? The only problem is we just don't know when. As they say, timing is everything. And as always the case, as we said yesterday, a recession will occur, and it'll be the function of some exogenous event that we are not looking for. And, this is kind of a key point, because and again, we brought up this. Let me go back to this one other chart here real quick, and let's just review a little bit of history here. So again, we were talking about yesterday about 2019 as a good example. In 2019, the Fed was cutting rates back in July. We were doing this massive repo operation. Yield curves inverted. More than 50% of our yield curves were inverted, right? Warning of a recession coming. The National Federation of Independent Business, all their indicators were ringing off a recession alarm bell, but yet no recession, right? And we talked about a soft landing. Then in 2020, we shut down the economy. Had a recession, big 35% drop in the market, so forth and so on. Now, the recession indicator was clearly wrong in 2019 because there was no obvious issue of a recession. And of course, the excuse given to you by the media is, well, nobody could have predicted the pandemic, which is true. Nobody could have predicted that. But the economy was already in a position to have a recession. All it needed was a catalyst to start it, right? And that's what we talked about yesterday. It's all about, building a fire. You've got your kindling, you've got your lumber, you've got your lighter fluid on it, you got everything ready to go, but nothing's going to happen until you throw a match on it, right? Or strike a spark, however you rub two sticks together, whatever. However you get the fire started, whatever that catalyst is, that's what was required to actually start the fire. And so, the pandemic, nobody could have predicted that, right? But that was just the catalyst that pushed everything over the edge. So what the yield curves are telling you right now, and why it's risky for this idea of sell cash, buy equities, yes, you should do that right now because the markets are going up. There's no reason to be in cash at the moment, that type of thing. So I get that point. In the short term, sure. But all the other indicators are telling you there is a risk of an economic downturn. It just needs a catalyst. Now, whether or not we get that catalyst is unknown. If, for some reason, we can navigate the world here long enough and the Fed does cut rates and we ease mortgage rates and we reduce financial stress on households and all these potential outcomes that we need to have done, you can certainly remove the risk of a recession by doing that, as long as nothing comes along and smacks the economy upside the head before you get there, right? So, that's the whole risk we run going into next year. And this is what will happen. Something will happen. You'll go into the recession, theoretically. And I'm not saying it's got to be a massive crisis. It doesn't have to be the financial crisis, right? Just a recession. But everybody will say the excuse from the media will be, well, nobody could have seen that coming. Had it not been for that, we wouldn't have had a recession. Well, that's always the case. It's always the case. If the guy hadn't run into me on the freeway, I wouldn't have been in a wreck, right? Nobody could have seen that coming. It's the way it always is. All right, quick break. We'll come back, wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Coming up January the 27th, we're having a special event. It's called Navigating the Markets in a Presidential Cycle. Greg Valliere is coming to be the keynote presentation. Adam Taggart will be there. Michael Leibowitz, myself, will be spending the morning talking about the economy, the markets, presidential election cycles, what to expect. Tickets are on sale right now. Early bird registration on the website. If you go to realinvestmentadvice.com, click on the banner at the top. Tickets are $99. We've got very limited seating at Hotel Sonesta here in Houston. You get your early bird special now. Ticket prices will go up as we get into early January. Get your tickets now on the website, realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. All right, just getting kind of ready to wrap stuff up this morning. Futures are pointing higher again, which has been kind of the ad nauseum case every day. We just talk about the, hey, market's going to be up again today. And this is, certainly a welcome change from where we were in October, where the market was just opening down every day, right? And, that was certainly a bummer and made the October holidays, not so pleasant. Market's under a lot of stress. So it's certainly a very nice as we move into the holidays. Christmas, markets are doing well. That's going to alleviate some of the pressure on spending for retail consumers. In fact, people are looking to spend more money this holiday season, mostly because things are higher in cost. But higher asset markets, that certainly contributes to that. People want to spend more when they feel good. Right? I feel markets are doing great. My portfolio's up. Things are doing well, and it's awesome. So hopefully this all kind of play through. We'll have a good Christmas holiday shopping season. We'll see. Of course, we'll see what happens with retailers once we get into January, February. It's interesting. Over the weekend, there's a clip on television right now. Texas bill lets police arrest illegal border crossers. And this has been a bill of hot debate as of late between Texas and the federal government. They don't want that, obviously. But I thought it was interesting over the weekend. Danny Ratliff and I went down to a ranch in southern Texas, and the ranch actually sits right on the Rio Grande. So we walked down, had lunch on a mesa that overlooks the Rio Grande, and we were talking about the problems that they have with they find illegal immigrants on their property all the time. Unfortunately, some of them are dead for one reason or another. But, Border Patrol regularly patrols, up and down their property. But it's kind of just a very interesting, fact that, when you take a look at the river, it's not deep. I mean, you can just really kind of wade across it. And, there's not a lot of, protection from that. So it was just a very enlightening kind of conversation. You hear a lot about, illegal immigration and what happens on the border. And when you actually go down there and see it, kind of firsthand, it gives you a very different perspective from what you actually see on television. And so you have a little bit of a different appreciation, kind of for what's going on and the challenges that they deal with on running their ranch, as well. So, they've got issues that they have to deal with. And there's a tremendous amount of compliance between, their ranch, the USDA, the Border Patrol, and like we go to a gate, like something I didn't know, right? So like we go to a gate to cross different pastures on their ranch, and there'd be like 6 locks on it. And I was like, why all the padlocks? Did y'all lose the keys to the other padlocks? And they're like, no, everybody's got a padlock. We have our padlock, the USDA, the Border Patrol, the agricultural, just the FDA, everybody's got their own padlock so they can go in and out of the ranch as needed. So again, it just gives you a really different perspective when you actually, kind of see it firsthand. So I encourage you to do it if you get a chance. Go down the border. And by the way, it's just absolutely beautiful country anyway, outside of the cactus, but cactus everywhere. But outside of that, it's actually a very beautiful country. Good place to see. Anyway, getting ready to wrap up this morning. Not a lot going on overall. Again, we're through earnings season here. Today, we've got earnings from Accenture and FedEx. So again, FedEx is always interesting because that kind of gives you a bit of an insight into what's going on in terms of the shipping business, right? So if they come out and say, oh, volumes are really down for this time of year, well, maybe people aren't ordering as much. But again, you've got more competition as well. Amazon's now becoming a severe competitor for FedEx and for UPS. So, just because FedEx says their volumes are down doesn't necessarily mean that that's the case if people are ordering from somewhere else. But it's always an interesting look at, they are very economically sensitive. So it's always a very interesting report to pay attention to in terms of traffic volumes and, other issues that are related to how the consumer is acting. How much are they shipping or receiving on a regular basis. Then tomorrow, we got General Mills and Micron Technology. But we're rapidly running out of companies for this earnings cycle. So again, it's once we're about to hit into blackout for companies, starting next week, and then we're going to start earnings season right when we get back from New Year's already. It's going to be hard to believe, but yeah, we'll be kicking off quarter four earnings season starting in January, and that's going to help give potentially a lift to this or not, right? So this is going to be the big case. But if earnings come in as expected, right, we're about to get into that cycle again where companies we've been lowering estimates through the month of December. So we're about to start January. We'll get into Q4. We've been lowering those estimates all during the month of December, brought those down a good bit. So again, we'll play the millennial earnings season. Companies come in, beat earnings estimates. We run stock prices up because of them beating earnings, and we start ratcheting up expectations for the rest of the year, and then we start ratcheting them down again. So, we're going to go through that whole cycle, but earnings season will provide some support for the markets as well. So again, if you're expecting a big crash, that's probably not going to happen. Not right now. And as we were saying, the problem is that in order for that big crash to happen, you're going to need some exogenous event that nobody is thinking about. See, this is the important thing we're talking about. You can say, well, Lance, what about Israel? Market knows about it. Well, what about Ukraine? Well, market knows about it. Well, what about, this or that? Well, market knows about it. If the market knows about it, the market's already factored it in. It's got to be something totally unexpected. Good example, 2008, market's kind of going down. We're having a bit of a bear market, nothing major. Yes, there's certainly some stress in subprime. There's some stress in the housing market. And yes, markets are responding to that. We're in a very normal-ish market decline in 2008. Then Lehman is forced into bankruptcy over the weekend. Nobody expected that to happen. Markets wake up Monday morning and you're down 4,000 points on the Dow in a couple of days. That's where the bulk of the financial crisis occurred, was between September, when Lehman was forced into bankruptcy, and November. Again, totally unexpected event. And that's always the case. And as we got into 1999, everything was fine in 1999. Heading into 2000, everything's cool. Jim Cramer on CNBC going, hey, here's 10 tech stocks to buy for the next millennium, despite the fact that 3 years later, all of them were bankrupt. But, everything was fine until Enron blew up, WorldCom blew up, Global Crossing blew up, and the bloom came off the rose. And nobody expected that to happen in 1999, early 2000. Everything was fine. And then it wasn't. And then once one company went belly up, everybody started going, well, if Enron, the darling of Wall Street, was a complete sham, maybe I better examine all these other stocks I own in my portfolio. Oh, there's WorldCom. Oh, there's Lucent, there's Global Crossing, there's, just the list goes on. And it was just one company after another. And they just, as you started kind of peeling back the layers of the onion, there was just no stopping it at that point. So again, what causes these big market meltdowns or these big unexpected events? So, and you won't know what it is because nobody knows what it is, because it's got, in order to shift sentiment from bullish to bearish, in order to facilitate the crash that you're looking for, you have to have this unexpected event that immediately makes everybody sell everything. I don't know what this is, but I'm out. And they're all out at one time. That's what creates the crash. And you won't know what it is. So if you're listening to YouTube videos or whatever it is out there that you're listening to, and they're like, oh, the debt's going to cause a major crash in the market. No, it's not. Markets know about it. Well, yeah, but it's the real estate. It's a commercial real estate market. Market knows about it. Market's been looking at it for a year. Could the commercial real estate space get worse next year? Absolutely. This whole work from home thing has completely shot a stake through commercial real estate, at least for now, till we decide that we're going to quit working from home. But the market knows about all that. Market's already priced that in to a large degree. So again, this is why you've got to be real careful with these super negative views on outcomes. The market, whatever you think you know, the market already knows. Unless you see something that is totally out there that nobody's even thinking about, and you've got a bird's eye view on it, and you're sure it's going to happen. That's the only way you're going to know. The only thing that we do have clues about is inverted yield curves, a lot of these other economic indicators suggesting a recession is likely, and the fact that we have a record number of economists now saying, oh, there's a guy on CNN right now talking about, a recession avoided. Mark Zandi, who's never right. This guy is never right, saying no recession. So if you ever want a good reason to go, he's it. But the point is that everybody thinks a recession's avoided, but you have these inverted yield curves. Odds are we'll have to deal with that at some point, but it's going to take some event. So just keep that in mind. That's the whole point of today's conversation. Articles on the website with all the charts. That's there for you if you want to go review all that on the website, realinvestmentadvice.com. While you're there, make sure you get registered for the summit coming up January the 27th with Greg Valliere, myself, Adam Taggart, Michael Leibowitz. We're talking about the markets, presidential election cycles, what to expect next year, how to manage your money, all those. And we'll be doing a live Q&A, so you'll be able to ask all of your questions. But you've got to get your ticket now. They are selling out pretty quickly. We've only got 150 seats. It's on the website now, realinvestmentadvice.com. Just click the banner at the top of the page and we'll see you there. But have a great day. We'll see you back here tomorrow with Danny Ratliff for the Wednesday's edition of the Real Investment Show.